QuickBooks Online 2025, short-term investment in stocks and bonds, dealing with unrealized gains, realized gains, and recording the sale of the investment. Get ready and some coffee because we're learning how to save time with QuickBooks Online 2025. Here we are in our QuickBooks Online Get Great Guitars 2025 Project 5 we set up in a prior presentation. Let's open up those major financial statement reports, which are located on the left-hand side. We're in the Standard Reports tab under the Favorites section. Right-clicking on the balance sheet to open a link in a new tab. We will be right-clicking on the Profit and Loss, otherwise known as the Income Statement, also opening that link in a new tab. Tap into the balance sheet to close the hamburger. And then we're in the modern view mode these days. Therefore, we're going to select the drop-down because that's where the custom date range is. I would like to see January and February side by side of 2025, going from 01/01/25 to 02/28/25, the full range. But then we're going to go to the Display tab, select the drop down, and under the dates, we would like to see the months. Closing that out. The refresh button doesn't need to be hit right now, but that's where it is. We've got January and February side by side for 2025. Let's go to tab to the right and repeat the process. You got to close the hamburger, select the drop down, custom date range, tabbing, going from 01/01/25 tab, 02/28/25 tab, selecting the display, dropping it down so we can see it in terms of months, por favor. Closing it out. There's the refresh button if needed. Not much activity in February of 2025 yet, but that's what we're working on this time. All right, now we're going to go back to the first tab, but we're going to do another transaction. This one being one that's not repeated all the time, but might happen on a periodic basis. So remember, the general idea is when we think about our accounting process, we have to do the setup process, which often will require transactions that we don't repeat all the time. But then we're going to have the normal transactions, which are typically done with the plus button by the forms, which are broken out by cycle, customer cycle, or in essence, ultimately money coming into the business from what we do, earning revenue. And then we've got the vendors section or cycle, which is basically ultimately money going out for things that we consumed, goods and services, expenses to generate revenue typically. And then we have the payroll. So these forms are set up for those types of things that happen on a general periodic basis. But some things don't happen on a periodic basis, such as the purchasing of property, plant, and equipment, for example. And in this case, we're gonna look at the short-term investment in assets like investments, stocks, and bonds. Now, there's a few things I want to basically touch on as we think about this, remembering that the general idea in bookkeeping is that we want to keep things separate from the business to the personal. So when we're talking about small businesses, then that's often hard to do because people are kind of mushing the things together, right? In other words, you could have the same QuickBooks file even for both your business and the personal, or the same checking account for business and the personal, but you got to break out the business side of things so that you can at least comply with, in the United States, income taxes, filling out, in essence, an income statement in the form of a Schedule C. You might be able to get away with something like class tracking to do that, but it's still kind of combining things together. Ideally, what we want to do is separate those two things because they have different objectives, and we would separate them by hopefully having different checking accounts if possible. We would separate them by having a separate QuickBooks file for business versus personal if possible. Again, there's exceptions to the rules, but that would be the general idea. And if I'm in a business that's not there just to invest, meaning my business is not one where I invest in stocks and bonds to optimize that in order to generate revenue in the form of dividends and interest, which I can then distribute to the owners of the business. In our case, for example, we are a guitar shop. We have guitar lessons, we sell guitars. We're not in the business of investing in stocks and bonds. So therefore, when I have a short-term investment in stocks and bonds, the only reason I'm doing that is because I want the money in the business at some point in the future so that I can buy, say, property, plant, and equipment with it. Otherwise, if I had accumulated revenue, which I hope to do over time because we hope we're going to generate money, generate revenue, which is going to put money into our business checking account. What am I going to do as that money goes into my business checking account? Well, I have two major options that I can do. I can let it sit there, but that's not very useful. I can use it in order to help me generate my business more revenue, which means I invest it like we did when we started the business in things like property, plant, and equipment or inventory that we're going to help just generate revenue. What if I don't need to do that because the business is already set up? The store's running smooth. Everything's running like it should be running. Well, that means that when I start getting too much money in my checking account, too much, right? Then I'm not going to leave it there. I'm going to take it out of my business checking account and transfer it with a draw if it was a sole proprietorship or dividend if a corporation to the owners of the business, which would be a sole proprietorship if a partnership, partners if it's a partnership, or shareholders in the form of a dividend if it was a corporation. So that's the point, right? We're not in the business of just holding on to the money. We're not even in the business of investing the money in stocks and bonds. In our case, we're in the business of investing in what we need to invest in order to generate revenue, which leads to the other problem that people often have, that being the term investment itself. Now, if you hear of investment on a personal finance side of things, stocks and bonds is what usually comes to mind, right? But on the business side of things, you could use the same term, investing in something, to invest in, say, property, plant, and equipment, for example. You're investing in the asset that you're not consuming at this point in time. It's not an expense that you consumed. You're putting it into the property, plant, and equipment, which is going to help you generate revenue over a long time in the future. If we're buying something for our shop, if we buy a special tuning machine that costs $10,000 or something, whatever it is, then that machine has a specific purpose. That's a big investment, a big risk that we're taking, assuming that we can get a return on it by using it in the business. It has no other purpose other than investing in the business. But what we're talking about here is the more restricted term of investment, investing in this case in like stocks and bonds, the term typically thought of in personal financial investments. Now, also note that you can use QuickBooks for your personal side of things as well. Works great. The only thing about the personal side of things is you don't have the same goal of revenue generation. Therefore, the objectives are a little bit more difficult to define, but the tracking of inflows and outflows can be done just like you can on a business, double entry accounting system, assets equal liabilities plus equity, or your net worth, if you want to think about it basically that way. Ideally, though, you'd like to have two QuickBooks files then, if you use QuickBooks for your personal finances, so that you can use two different checking accounts and that you can use two different QuickBooks files and keep them completely separate. But sometimes you don't want to pay for two different QuickBooks files, and you don't want to deal with the inter-transfers between the two. So if you're a really small business and you just have a Schedule C, you might be able to use class tracking on the income statement, which would allow you to generate reports breaking out the income statement by personal items versus business items. We have a whole nother course or section on that. Bookkeepers don't like that, of course. Why? Because in part, it's really difficult for us as a bookkeeper, especially if we're not the one actually spending the money, to be able to identify if something that you spent money on was business or personal, especially if it's coming out of the same checking account, right? So it becomes a little bit tedious. But if it's a small business, a sole proprietorship, you might be able to kind of get away with that and therefore keep all of your books in one area and generate, in essence, an income statement for your taxes. So just keep that in mind. Again, people have strong thoughts on whether that's a good idea or not, depending on who you talk to. But if I go back to the first tab, notice, so that means that we have this idea of putting money short-term into an investment, which could happen in many businesses and corporations, right? They're holding on to money because they're going to use it in the future, but they don't want to just keep it in the checking account. They want to put it into a investment in like stocks and bonds so they get a return on it. So that's going to be what we're thinking about in terms of this line item. However, if it's if you're using the bookkeeping for the personal side of things, you have a similar structure, in which case you will have a lot of tracking of the investments, right? You're going to have the investments as part of your normal financial items, and you're going to be recording the income from the investments, the dividends, and the interest. So remember, on QuickBooks, this software is not designed to track the performance of individual stocks or even mutual funds or ETFs. What you're doing in QuickBooks is to give you a general idea of where you stand as of a given time, year to date, month to date, quarter to date. And the more performance software, such as looking at whatever your investment is individually, right, with whatever, like E-Trade or something like that, will give you more detail about the performance of your particular asset groups, right? And you have all other kinds of software that you could use to track performance if you would like to. But what you want to do in QuickBooks is give yourself the balance sheet, the snapshot, and record the income. All right, that leads us to the idea of, well, what are the problems with recording this? Well, I don't want to record every individual stock, and I don't want to record even every mutual fund if I have multiple mutual funds. What I'd probably want to do is summarize this under like who I invest it with, my bank or E-Trade or Vanguard as the parent account, and then and that's where I would generally put the investments, right? And you could have a short-term and long-term. So especially if they were personal investments, you might break out the short and long-term by whether or not they are restricted to pull the money out, such as they're under a 401k plan or an IRA. So if it was your personal account, you might have the short-term, which is not under an IRA, if you have some that is not under an IRA or 401k, because you can actually access that money in the event of an emergency. And in the long term, you have the stuff that's under an IRA or something, because you can't access that unless you're in retirement. There's restrictions on it. So that's one way that you can break it out. You might want a parent account for investments, and then the sub accounts by your investment companies, financial institutions that you invest in. Then you're going to generate revenue from the investments, like dividends and interest. How do you record the dividends and interest? Well, when you get paid dividends and interest, if they go into your checking account, we're going to see that on the bank feeds if you use bank feeds, right? Because then they're going to hit your checking account. And you might then record them as income on the profit and loss as they come through. Now, I would typically put them on other income at the bottom of the income statement, because particularly for a business like our guitar shop, interest and dividends isn't part of our normal business operations. I'm not going to put it on the top line of gross revenue, but instead I'm going to say income minus expenses gives me my net profit from the business, and then I'm going to put any dividends and interest as incidental income that's not tied to my normal operations, so that I can see my operational net income and then the other income down here. So that's one thing to note. Note also, however, that you might have set up on your mutual fund that you want to reinvest the dividends and interest. So that means what's going to happen is you're going to get the dividends and interest, but they're just going to put it back into the mutual fund, buying more stocks of the mutual fund. So that means it's never going to hit your checking account. So you're never going to record the dividends and interest. When you're going to know about it? When you get your financial statements. So you're going to get your financial statements from the investment company like an E-Trade or Vanguard periodically, like at the end of the month, quarter, or year. And that's when you might update then your account. So then you're going to update your account here. Now, again, you have the same issue that you might have an increase in this number in part because of a reinvestment of dividends and interest, in which case what you'd want to do is increase your investment account here, because now you've invested more money into it, and the other side should be going to revenue. That's not a normal transaction because there's no cash involved. You would have to record that with like a journal entry. But you have an added problem. And the other problem is that the other way I can generate money or revenue from my investment is for the stocks and bonds to go up in value. So they don't just pay me dividends and interest. What they do is reinvest their money into the business, which should grow the value of the stock, and therefore the value of the stock has gone up. And if I were to sell the stock, I can sell it for a higher price. So what do I do with that, right? Let's say like just the value of the stock went up to 13,000. What am I going to do with that? Now, normally you would say, well, shouldn't I not record that? Because if it was like property, plant, and equipment, I wouldn't record that increase because I haven't realized it. We call that an unrealized gain. If it went up to 1,000 today, it could go down 1,000 tomorrow. I don't know. I haven't locked it in until I sell the stock. Therefore, I shouldn't record the revenue until I sell it. So there's arguments about this in the accounting world. When should you record the revenue? Now, notice in the United States, if you look at property, plant, and equipment, usually we say we're not going to record the revenue until you sell it. I'm not and so if it was like a piece of equipment, like a forklift, I'm not going to revalue the forklift every year and then record the forklifts based on my appraisal. Why? Because one, you have to take an appraisal, which is an estimate. Two, the forklift is unique. It's not like any other forklift, so I can't really tell what the value is. Three, it would cost money to do it because I have to do an appraisal. And four, it lends to the ability of corruption because appraisal companies have an incentive to give you an appraisal, which is just an estimate that's close to what you want them to give you. If you want a higher number, they might try to edge the number up just because of political pressure and whatnot on their appraisal, which is a danger as well. So therefore, we're just going to say, I want you to just allocate the cost. Now, that's depreciation. Now, with a forklift or something, the value always goes down. That seems like a pretty safe thing to do, typically. But if it's a building, you can see why that becomes a problem, because the building, although it'll depreciate in value, if you don't upkeep the building, it could still go up in value due to just location, right? So there's more of an argument for the building to say, well, what we should be doing, if the building went up by $10,000, I should record the increase of the building so I have an accurate balance sheet. Now, again, there's arguments over this because the problem is you have to take the appraisal. The building is unique. I can't compare the building to anything else. So all of these problems are why there's this kind of argument like with property, plant, and equipment. But with things like mutual funds and stocks and bonds, which are actively traded on a day-to-day basis and are not unique, meaning every stock is the same, we can get some idea of what the value is at any given time, which gives us more of an argument to say, well, then I should record this at the fair market value and not at like a cost value. So that's going to be the idea, right? That's why you might do that. We could say, yeah, well, it makes sense for me. If it went up by $1,000, I should record the increase because I know what the value is at that given time. It might go down again later, but it's not like I have to appraise it to get the value if it's traded on a public stock exchange. Now, if it's not traded on a public stock exchange, then I have the same problem. I have no idea what the value of it is unless I took an appraisal of it. I only know the cost of it, right? It would be the general idea. And there's still problems because if I had a lot of stock, like if I owned 80% of Apple or something like that, I can't just sell 80% of Apple at the value it's appraised at, because if I start selling it, people will think I'm tanking, the stock is tanking. So then the value would go down. So there's issues, right? But that's the general idea. For small investors, if it's publicly traded, I'm going to record this at the market value periodically when I get the statements on a monthly basis or on a yearly basis. And that's what we're going to do now. So I'm going to pretend that and then the question is, if this went up by 1,000, I want to increase this by 1,000 to match it. Now, you might make another account that would be a subsidiary account, which would show the unrealized gains and losses in a similar way as you have a subsidiary account to the property, plant, and equipment. Why? Because that shows you your gains and losses if you were to sell it. And if there's gains, you're going to have tax implications. There might be tax implications of losses too, but that might be a benefit if there's losses. All right, then there's another side. Where does the other side go? What's the other account that's affected? You have two options. I'm not going to get into the rules for generally accepted accounting principles, but the general idea is that you could create another account in the equity section that would just be the opposite of the unrealized gains and losses. But that's kind of tedious. a lot of small businesses aren't going to want to do that because it's more confusing. So what you will typically do is record it on the income statement as unrealized gains and losses, which again, I would report as other income or expenses on the bottom down here. Now notice that if you're talking about gains or losses, you might have a gain or you might have a loss, right? So you could make two separate accounts and record the gains and losses in the two separate accounts, or I think it'd be a little easier to just create one account that has gains and losses, recording it as possibly an income account, so that if you had gains, it would record a positive number for income, and losses would record a negative number for expenses. All right, let's get a general idea of this. Let's imagine that we sold this investment, but where did the investment go? Donde está? 12,000. Let's say it went up in value, and so now I have to sell it. So what would be the transaction to sell it? So first of all, what would be the form that I'm going to use? Well, it's not a normal transaction, so there's not a normal form, but the question would be, is cash affected? If I sold the stock, it would be affected. It would increase the checking account. I would see it come through the bank feeds. So that means I could use like a deposit form, for example. So let's go to the first tab. I'm going to hit the plus button up here, and let's use a bank deposit form. And so it's going to go into the checking account. Let's make it as of 02/02/24. And all right, so let's tab through this thing. We go and then so then we're going to have the bank deposit to an account. Now notice we don't have the top bit of the deposit that would be showing up if you had anything in the funds to be deposited, the clearing account. In our case, we're going to record it directly into an account. So if I got a deposit because I sold the investment, I need to make this investment account go down to zero. But let's say I got $12,250. I can't post $12,250 to this account because it'll make it negative. So where does the 250 go? The 250 is going to have to go to income. Therefore, three accounts are impacted. So I'm going to say this is going to be investment, short term. And then I'm going to say 12,000 is going to be the other side. So cash is going to go up. The other side is going to be a credit then here. What happened to that? Payment method. We're going to say, wait a sec, where's the amount? 12,000 over here. All right. And then the next one is going to go into some kind of gain. Now, I don't think there's going to be a gain in the accounts that they gave us, so we're going to have to add it. So let me just check if I type in gain. I don't see that here. So let's say we have gains, let's say, and losses on investments. Let's say, hopefully I spelled that right. Let's add it as we go on the fly. All right, we're going to do it on the fly, which is hard when the little fly's wings are flapping, but you're on the fly, and we're still going to do it. So then we're going to say, I don't want to make it a normal income account. I want to make it an other income. Where is the other income? Right there. That means it's going to go on the bottom of the income statement. Dividend income, interest, other investment. Let's put it in other investment for the sub account. Do I make it one? No, I'm not going to do a sub account, so I'll keep it there. So we'll save it. That should do it. And then the amount I'm going to say is $250. Okay. So that means that this is a deposit of $12,250. Notice what QuickBooks is doing. It doesn't give me a field to enter the amount of the deposit, which is the amount I most likely know, because that's what's going to hit the checking account, $12,250. Instead, we're going to put the other side of the transaction in place, and then it's going to put the plug in of what the deposit is. So this should add up, of course, to the deposit. The other account that we put it into is the short-term investment. Is going to go down by 12,000. So that asset account is going to go down. And then the gain and losses on investments, which is an other income account, which is going to show up at the bottom of the income statement because it's other income instead of income or revenue. So that's going to be $250 increase in income. And then those add up to $12,250, which is going to be the increase or deposit that goes into the checking account. Let's save and close it, and then we can check that out to see if that is indeed what is going to happen. Let's go up to the balance sheet, refresh it, and it's doing that. That's okay. We just say refresh it again. Por favor. And we'll go into the February data. And so there it is. So we have the 12th. Where did it go? Donde? Okay, I think I put it in there for 2024 because I was using my cheat sheet from last year. So let's change the range going back to 24 so I could fix this. So there's the 224. See if I can open this in a new tab. I'm going to right click on it, open the link in a new tab so I could fix it over here. I'll pull it to the right. And then, yeah, not 24. We're working 25, man. What are you doing? You're living in the past. You're living in the past, man. You got to be in the present. All right, let's close that out. Let's try it again. Let's close this out. And then I'm going to refresh it. And then, so let's refresh it. And now let's go back, save, and exit. Exit without saving. Refresh. And then let's go back into here again and see if it now shows up properly. There it is, 12,250, deposit in place. Boom, shock, lock, All right, and then we're gonna say down here in the investment, it was at 12,000, it's now gone. It has disappeared. They won't let me click on it because it's a dash, which is kind of annoying. I'll mess with that later. Let's go into this one, and then I'll change the date range. So we're gonna change the date range to, let's say 2/02/28/25. All right, so there it is. So it was up, and then it went back down. That makes sense. All right, let's go back and exit without saving. Let's go to the P&L, otherwise known as the profit and loss, the income statement. It's not on the income side of things, but it's down below on other income. So there it is. If I go into it, well, there's the 250. Let's just keep it there. So why do I want it on the bottom here? Remember, the idea is that I'm not in the business of generating revenue from stocks and bonds. If I can get a little extra cash by parking my cash in stocks and bonds, get some dividends and interest, I'll do that. But it's not what I do primarily because I sell guitars. I'm a musician, okay? I'm an artist. So we're going to say we have revenue minus the expenses is my normal income from operations. And then we have this other income at the bottom. We want to put it on the bottom here. Now note that if these were unrealized gains and losses, remember that you could have an increase or a decrease. This could well have been a loss. That means this is other income. There's also an account category you can put down here for other expenses, which you might put the losses in. But that's tedious because what you want to have, I think, would be easier, which is what we have here, is one account that's going to handle both the increases and the decreases. So if it's an income account and it happened to be income, a gain, even if it was unrealized, even if we didn't sell it, I can record it, it would be an increase. If it happened to be a loss, even if we didn't sell it, if it was unrealized, it would be a negative income account as opposed to a positive expense account. Now remember, other things could go down here as well. Why would you put something down here instead of in the normal categories of business revenue, business expenses? Because they're not part of the normal operations. So that means maybe interest expense might go down here. We might move that down here later to give you a feel of why you might do that. Because although the financing of expenses, the paying of rent on the purchasing power of money is something we need to do if we don't have any money, it's not really part of the normal operations. It's only there because we didn't have enough money for the initial startup costs. So we had to pay the rent for the money that we need for the startup costs. All right, so we might put that down here. Or if you had like a hurricane or something in an area possibly that doesn't have hurricanes oftentimes, then you would have it down here, right? If the hurricane happens every year and you always deal with hurricane damages, then that's not really unusual. You could expect that to happen in the future. You would think that would be a normal type of expense. But if you're sitting over here, like I'm in the middle of, California or something, and I had a hurricane suddenly blow my business down, blow all my guitars out of my store, that would be unusual, right? So I might put it down here. Why? Because although it's a normal expense in the business, it's still an expense of the business. It's not likely to happen again. And therefore my income statement would be difficult to use for predictions in the future if a one-time event is having a significant impact on the bottom line. That's the general idea. All right. So if I go back to the first tab, that looks good. This is where we stand as of right now. So I'll just scroll down relatively slowly. Here's going to be the P and the L. This is where we stand as of this point in time. And then we'll go to the trial balance. Let's go to the trusty trial balance, first tab, going down to the reports. Where are the reports? Where did they go? I'm in the reports. Dude, are you blind, man? I'm trying to work out my bad eye. So I can't see that well because I like try to put a patch on my good eye so I could try to work out my bad eye. So yeah, I can't really see. Let's go from 010125 to 022825. Run it to refresh it. So I want to see it side by side on the months and then run it. So this is where we stand. We've got the balance sheet on top of the income statement. The balance sheet goes from assets down to here. That's the contra asset of accumulated depreciation. Liabilities from the AP to the payroll. The equity from the opening balance equity to owner's equity. The income statement going from the revenue accounts. Here's the revenue accounts down to the normal expenses ending at utility and then tacking on that other income. Also part of the income statement on the bottom. Remembering that this February data is year-to-date data in February. It's not just for the month of February. So keep that in mind as you're checking things out. If your numbers don't tie out to my numbers, you might check your January numbers and see if those tie out. If that does, then you know that the problem happened in February, a little troubleshooting for us. And then if it happened in February, you might change the date range, increase in the date, because you might have entered something in the current day or something, done the opposite of what I did, entering it in the past. So then you're looking into the future. I'm living in the past, right? That might have happened. So if that changes it, you go into that number, drill down on that number, get to the source document, put the date into the proper date, and see if that fixes it. If not, we will do reports at the end of the first month of data entry, transaction detail reports, which might help us to further find any inconsistencies.